Thank you for joining us. Somehow, FIs are not enjoying a lot of love and affection by Indian viewers and Indian investors now. Are you part of that club who's selling every day?
No, really, Nikunj. We've been just kind of waiting on sidelines. And if you would remember, last 6-7 months, we've been a bit cautious on the markets. Our view was, look, what is happening is Fed is going to withdraw liquidity. Fed was sounding a bit hawkish. After a long time, we see rates moving up. So you weren't sure how this dynamics plays out. And except China, most markets were not cheap on valuation. So some bit of a valuation correction had to happen. I think that's a process underway now. And as we've kind of maintained, the medium long-term story is attractive, but the near term is going to be bumpy. So it makes sense to be on sidelines for a while before valuations get really attractive, or before we see some of these inflation concerns and globally get mitigated.
Okay, so the big question, Rahul, which we are perhaps asking and trying to address for our viewers is that are Indian markets attractive? Or in terms of valuations and attractiveness, they need to fall much more?
Okay, so there you've got to look at the pockets of markets. See, there is a pocket which is financials, which is super attractive. Earnings are good. So the micro is best it could be, but financials gets most impacted by macro. And what is the vulnerability for macro? It's the high inflation. More importantly, the worry coming on crude. And I think the real test for this crude concern comes 6 months from now, when a lot of these European insurers stop insuring the Russian crude. See, right now, India has the option of buying Russian crude at a $30 discount. So which is why one is not really seeing oil spike up. But look, come October, November, when the vessels are not able to carry Russian crude, does it mean that crude goes to 150, 175 for a demand destruction? That is to be seen. And I think that's really something which is holding back most global investors from adding to financials, because one is not sure on what happens on crude. Outside that, we are seeing some bit of other hot commodities correct. Look, Fed's been tightening, it's been sounding hawkish. So that's playing out in some of these commodities which are traded on LME. Look at aluminium from April 20th. It's down nearly 30%. Same things happen with lead, copper. So I think the two pain points are food or agri-commodities and oil, basically.
Rahul, let me rephrase my next question rather carefully. Are we in a volatile market or are we in a bear market? A volatile market means that this is a time when if you're buying, you will be rewarded. But if we are in a market where asset prices are getting repriced, then the downside could be much more severe.
Okay. So, Nikunj, I would be still in the volatile market cap. Okay, let's see what Fed's been talking about. See, why did Fed take a 75 bips hike? Because what they saw over the weekend was this inflationary expectation spike up in US. What we saw from a Michigan consumer inflation index, it inched up. And look, Fed doesn't want inflationary expectations to be unanchored, and which is why they sounded hawkish. So their point was, look, the core inflation is still kind of a manageable, but the headline inflation, which comes because of food, oil, is high. And they know a lot of it is supply driven, but look, they have got no control on supply. And just to keep the inflation expectations in check, they want to get that demand a leg down. Now, our view still remains that, look, the consumer is going to be reflexive. We've already seen manufactured good demands kind of come down. We've seen inventory build up in US. What one needs to see is wages go down. As you see some bit of a firing, some bit of a scale back on hiring by companies, the wages should go down. And I think what Fed is also doing is moving to neutral very quickly, and then they'll take a breather. So at least, again, our view is for 6 months is going to be very volatile, because what's also happening here is Fed is contracting balance sheet. For most government securities, Fed was the biggest buyer. So you don't know how it plays out. But once the demand kind of reacts to it in terms of a level lower, once inflation settles at a more palatable level, focus would come back on micro, focus would come back on fundamentals, which remain very healthy for an economy like India.
Rahul, hi there. Good morning. If we look at individual sectors, the auto stocks haven't really participated in the rally. We have seen concerns when it comes to the chip shortages, commodity pressures. Is that what's holding some of these stocks back? Or do you think that, we are likely to see a recovery and we will see strong momentum pick up when it comes to autos?
I think for next 6 months, stocks will do their jobs by not falling. So I don't think we're going to see significant up moves in the market on a sustained basis. What we'll have is a lot of these short covering rallies, but till the time we get clarity and that look, inflation is manageable, the market is going to be choppy. And from an individual sector stocks perspective, a lot of these semi concerns are going to ease out. We've already seen the likes of Samsung and Apple go and tell their vendors that look, smartphone demand or is going to be lower. So those orders have been cut by 10-15%. You're hearing all these talks of some of the concerns for auto semis getting eased out. So I think autos is a sector which we've discussed before. Look, demand is nearly or at a level which was 3-4 years back. There's a huge pent-up replacement demand coming through. So this sector should hold on. It's an under-owned sector, so would relatively outperform the market.
You continue to remain bullish on consumer discretionary FMCG despite all of the concerns that are very well known?
So again, in consumer discretionary, what we were doing was we were selling the expensive retailers and moving to autos. That's something we did in March, April, largely being positive on the rural economy. So I think that's a trade which has worked well. Staples were more of defensive. One knew that, look, there was a bit of a downside because of multiples, but the idea was that staples in this market would outperform financials. So which is where we were cutting our overweight on financials, moving them more to neutral and taking that money to staples. Staples were largely good proxy for rural recovery also. So continue to like staples, autos within the discretionary pack.
Right. Thanks very much for spelling out some of those sectors where you see strong value, Rahul. It's been a pleasure having with you on the channel. All right.
From there, SGX Nifty indicating a mild positive start for us. But you know what?